The slowdown of China's economy poses a significant threat to the global economic landscape. While China has managed to navigate the challenges posed by Donald Trump's trade war more effectively than the United States, largely due to its diverse trade partnerships, its internal economic growth is now showing signs of distress. In the last quarter, exports from China increased, contrasting with a decline in American exports. However, the overall domestic economic indicators are less encouraging. For instance, industrial production saw a growth of 5.7% last month, which, while impressive by Western standards, represents a notable decline from June's 6.8% growth rate. Even more concerning is the fact that retail sales only increased by 3.7%, a sharp drop from the previous month's 4.8% growth. This decline is particularly alarming because the earlier figure of 4.8% was already considered low. A fundamental issue plaguing China's economy is well known. Domestic consumption is insufficient for a nation at its current stage of development. Currently, domestic consumption accounts for just over half of the total economic output, which is significantly lower than the approximately 90% average seen in most developed nations. This gap has widened as consumer spending has weakened, particularly following the downturn in the housing market. Since property investment serves as the primary savings mechanism for many Chinese households, the decline in this sector has led families to tighten their budgets and increase their savings instead. In response to the lack of domestic demand, many companies have turned to boosting their exports. This strategy has flooded the global market with low-cost goods, leading to growing frustration among trading partners. If it hasn't reached that point already, this export-driven growth model is now nearing its limits. So what is the remedy for China's economic slowdown? The answer is straightforward. The country needs to decrease its investment levels and enhance consumer spending. The Chinese government has been attempting to achieve a long-overdue rebalancing of the economy and has seen some success in major urban areas. In these cities, the housing market has stabilized, the proportion of investment in local output has diminished, and local governments have directed any remaining investments toward high-quality strategic industries. However, smaller cities have yet to fully embrace this new strategy. Confronted with declining growth rates, local governments have resorted to increasing investments to meet the national target of over 5% annual growth. This approach has resulted in excess production capacity, unprofitable businesses, and falling prices, which only exacerbates the downward trend for Chinese companies. To effectively rebalance the economy, China must first address its excess capacity by allowing many producers to fail. Some estimates suggest that as many as 80% of the current property developers in China may need to go bankrupt before the housing market can stabilize. While the decline may not be as severe in other sectors, such as automobile manufacturing, a similar trend is expected. The surviving companies will then need to invest more in employee compensation, whether through higher wages or improved benefits, to stimulate consumer spending. However, this shift would likely impact corporate profit margins, fundamentally challenging the existing economic model. Powerful interests that support the ruling party may feel threatened by these changes, making reform efforts even more difficult. China's economic challenges illustrate that even authoritarian regimes face difficulties when it comes to making necessary but painful adjustments. Interestingly, we are witnessing a convergence between the U.S. and Chinese economies in various respects. The potential second Trump administration appears to be leveraging its political influence to guide companies toward national objectives and penalize those that resist, resembling Xi Jinping's model of state-directed market economics. However, the more concerning aspect of this convergence is that both economies seem to be experiencing a slowdown, which could lead to diminished demand for goods and services from the rest of the world. In a global economy that is still grappling with the aftermath of the pandemic-induced recession, this situation is likely to raise alarms for many stakeholders.